I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are.
Last week we saw Facebook and Twitter take massive hits. Have they come back at all?
Yeah, I would call them at the moment weak recovery. The hit in each case was or followed, they've been going up very, very nicely. And each has a compelling story, and each are with social networks and internet and all that sort of stuff. And then with Facebook, there was, maybe this isn't working so well. And the news came out when the North American markets were not open, and bang, there was no bids, no liquidity. And then Twitter, a similar story. And after the event, we just took a look at it on our technical work. And, yeah, it did everything needed for a top. And then, again, it was a change in the outlook for their business, and wham. So I looked, then I'd recall that in the 1873 bubble in New York, which peaked in September, and then I looked it up, was that the big high-tech stock then was Western Union Telegraph. And the market was creeping down in September. Then all of a sudden, September 20th, the stock fell something like $65 to $45, just a horrendous hit. And the high had been 92, and then eventually, I think, in the crash, it got down to 40. So that was the big cap stock, high tech, and it got marked down. Oh, now I remember the number, 28% in one trading day, just hit like that. So these things happen, and so our theme is that the speculative burst that ran into December, January was very important. It could be the end of the bubble for the Bitcoin stuff, and it may be the top for the senior indexes like the Dow or the S&P. And this won't be determined until we see what happens in the fall, because, our seasonal work, we'd looked for a rebound after the hit out to around May, and that would be helped by what we called our friends of the bull market, which were industrial commodities going up, base metals and lumber, which they did. And now, other than crude oil, the base metals have been hit hard, and lumber is just taking a horrendous dive. So this is a warning for us now. Then the other one we work on, which is in the credit markets, credit spreads, they have stopped narrowing and have a modest attempt to try and reverse. We called it the first breakout. But in a market like this, or any peak of a stock market, you want to have the second breakout on the widening spreads. Then the other one is the yield curve, which everybody's talking about. I remember bull market tops and hardly anybody talked about the curve, but everybody's on it now. The main thing is that the trend with the boom has been flattening. That's what you get with every boom. And sometimes you get inverted, whereby short rates get higher than long rates. But we've got the chart back to 1860, and You don't need to have the curve become inverted. It just has to go to an extreme and then change. So where the pundits now are worrying about rising short rates and the flattening of the curve, that's okay. What matters is when it changes, and that's what we're watching for. So that changed. So our friends of the bull market are not as friendly as they were back in May. And as a matter of fact, the decline in industrial commodities is it's serious. But I think it'll become more noticeable when after August, we took a look at crude oil and on the seasonal basis, and through this period, the crude price can shift around. But no matter which seasonal study you look on crude, you have a serious low in December, January anyways. And then that's the other part. Copper can often have a seasonal low in November, lumber out there as well. So this, you're not going to have any support for the stock market from industrial commodities. And where the credit markets have provided support, they now are vulnerable to change. Then the other thing, if you look at the headlines, we've got, boom stuff about trucks, big trucks and trailers being bought, and you've got oil, equipment being bought. Everything's, there are headlines, and then headlines about the employment numbers. Everything's really good. Well, this is what you get in a boom. But this week there were two little news items that caught my attention. It was that in China, the headline was that investors were fleeing into money market funds from the stock market. So that speculative urge seems to have gone away. Then in Australia, you had their house prices fell the most in 7 years. And that's been a hot market. So there are some things changing, but we'll stay with our thing as we'll watch the yield curve and we'll watch credit spreads and industrial commodities. And all of this is suggesting a transition somewhere in the next few months.
We'll have more with Bob Hoye right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome back. We're chatting with Bob Hoye. Bob, the U.S. state and city pension crisis is huge. How huge is it?
Well, they had a headline on that one as well, and from the Wall Street Journal, and they said the pension hole for U.S. cities and states is the size of Germany's economy. And what that is you've had a game being played by civil servants and government at the municipal and at the state level, where they grind with their unions and get pretty good pay. But what cities have been doing is capitulating and giving them big on pensions. And the obligations are huge, and you're getting many people who were sort of doing average administrative jobs who, when they retire, get more money in retirement than the average taxpayer within the community earns. So it's because they've had a monopoly, so to speak, with the unions at the civic and state level. So this is going to be ugly, and I think what we'll have to do, Jim, is take a look at what happened to all the government pensions in East Germany and in Russia when the authority of the Communist Party failed. I imagine that a whole lot of those obligations were unable to be met. So this is going to be interesting. We keep looking at the municipal bonds in the U.S., which enjoy a tax benefit free sort of thing, and nothing too awkward showing there yet, but I think that a number of state or a number of counties and municipalities would likely go broke trying to meet their obligations. So whether a county or a state actually defaults or goes broke, you don't know, but there's going to be a tremendous financial convulsion at some point. So that's a warning on a lot of investors in the States own muni bonds, and it could become precarious. It's another part of the political struggle where people are looking at the extravagance of government. They're looking at how well the governing classes live, and then they look at their own take-home pay. And I looked at the numbers the other day, and in 30 years, the average wage, now again, this is using U.S. numbers because they're more readily available, the average take-home pay net of inflation is down about 3% in 30 years. So although there has been a continuing improvement in productivity in the economy, somebody's taken the money, and we know who that is. That's the government level. So this is where in the U.S. you got the popular uprising, which we've been talking about, and it chose Trump as its executive. I mean, the movement existed. Trump didn't invent it. And then now with Ford being premier in Ontario, you have perhaps the start of a popular uprising in Canada. They're taking an opposition to carbon taxes, but you want to look at the federal government and their carbon taxes. The big word is tax, and the carbon part it's sort of like the coating on a pill, makes it taste better. And certain parts of society are very much caught up in all this climate threats and warming and change and everything else, and are happy to go along with having a carbon tax. But all it is at the government side is tax. The carbon is the sales, the sizzle on the steak, so to speak. But when people are explained it clearly, they soon see what it is. So I think that the popular uprising that we've seen in the States is beginning to arrive in Canada. And, of course, Ontario has been one of the most corrupt sub-federal jurisdictions on the financial side in the world, because its per capita debt is the biggest of any sub-federal jurisdiction in the world, and even more so than California, where they've been crazy about energy as well. So it's going to be fascinating to watch this change as it percolates through Canada. So I'm looking forward to it.
We'll have more with Bob Hoye right after this.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, Apple, also known as Alphabet, has hit a new milestone. Its capitalization is now more than $1 trillion.
That's a big number. It's a huge number. And it is a headline number. $1 trillion is immense, a very big and a very successful company. And it's worthy of comment. And it is amazing because the company started with a couple of young guys in parents' garage tinkering around. And that, you even go back with Hewlett-Packard, those guys who started that tech company was the same thing. And it's a marvel of a free economy and entrepreneurship and everything. And all the congratulations they are due them. So it's a very big number, and we'll take a look at the stock and see if it's getting overbought.
Well, we also had Amazon in the race to $1 trillion, and they're not far behind either.
Yeah, Amazon is an unusual company. It's an amazing company. It doesn't make much money, but it sure builds assets and whatever. And that's another one that started with Bezos, had this idea that he could sell books on the internet. And one thing led to another, and away it goes. So again, another example of what happens within a relatively free economy and a free market. So, but a lot of these things, Jim, the market has been very, very speculative. And investors can think that they're safe because they're owning investment-grade stocks. But if other outside speculators have bid them up to horrendous prices, even though you think you're safe, you're vulnerable. And what we like to look at is what happened to different investment vehicles in periods of market setbacks. And I know the one we've mentioned it before, I've mentioned it again, is the 3 to 4 year good grade corporate bonds. You won't get hit on price risk, and you won't get hit on credit risk. And for Canadians owning U.S. corporates like that, you'll get the benefit out of a probably rising U.S. dollar relative to the Canadian. So I kind of like that part. Most people think of gold in a storm. You want to have some, as they say, for insurance, but to try and make money out of gold in U.S. dollars is going to be difficult because the gold itself is a liquid item, and in a storm, the careful money goes to liquidity. It doesn't whether it makes money; it just wants to get it back. And the other very liquid item are short-dated treasuries in the U.S. So there'll be a bid for treasuries, and that means a bid for the U.S. dollar. So we can't see gold in U.S. dollars doing anything sensational. But in any other country where the currency would drop relative to the U.S. dollar, you'd make some money in gold. But I just would prefer the returns you can get out of the 3 to 4 year corporates. And there will be a time out there when one can look at the gold stocks for a serious investment as well as for traders, but we're not there yet. We'll be there at some time, and I think we'll be able to catch the moment when it turns to a time to get positioned, but not doing nothing there until that time.
Bob, what's your feeling on the Russian sell-off of their U.S. debt?
Oh, it's a market. The central bankers should be exclusively in gold as a reserve, but they all got portfolio theory disease. They're all economists, and they've learned all the same recipes. So they've been handling central bank reserves as if it was a portfolio. So they're owning U.S. treasuries out to whatever term. Some of them have been buying equities, such as the Bank of Japan. The Swiss bank has, of all things. So they're all fully committed to stocks and bonds continuing to go up, and they're not doing their countries or their country's currency any good by, losing the discipline of maintaining a reserve in gold. And here again will be another instruction in practical financial world coming at us. So what you see with the central bankers, let's go back to 1998 when long-term capital management was set up by two leaders in economic theories. And they had raised a lot of money on a speculative hedge fund, and the central bankers were eager to do business with them, and so it loaned money to them. And the Bank of Italy, of all things, not only loaned money to this speculative fund, but they even took an equity position. And the main position was to playing the spreads as Europe Community Union came together. The theory was that the spreads for the interest rate for Italian bonds, they would trade close to the rate for, say, German bonds or British and that sort of thing. And so that's what their position for was, that all these different interest rates would converge. And of course, they didn't look back into history when those countries back in the early 1900s were on a gold standard, and there was still a divergence in spread yields between England and Italy, for example. So it was a huge wager based upon the theory that with the European Union, all these country debts would trade at the same yield, and it didn't work, and it began to come apart more publicly in June, and then July and August of 1998 was just a disaster for them, and the whole $4.5 billion hedge fund just collapsed, and it was a panic for the central bankers because they had lent the fund money, and of course I guess Italy had a lot of embarrassment, but here they are now, even more aggressive than with that improbable position. So I think that there will be a contraction. It's inevitable because that follows every great speculation. And at this time, you've had the central bankers highly speculative, you could say recklessly speculative. And I think Mr. Margin and Mother Nature will do what they usually do to people who are over-leveraged. And when that comes, it'll be absolutely fascinating. So there's a lot of theories at work and employed in this great bubble, and the contraction will do a number on theories that have not been well-founded. So for either the practical person or those who are fascinated with economic theories, it's going to be very interesting times, Jim.
Bob, thank you so much for chatting with us.
It's good to be with you.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. If you have any questions for Bob or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.